You hear a lot about companies being asked by their accountants for impact assessments of Pillar 2 for their accounts this year. So I thought let's have a look at the Globe Info return and talk through a high-level impact assessment. So here is your Globe Information Return. I believe it was published in July 2023, and this is going to be the basis for our Pillar 2 tax returns. And they've already published the boxes that we're going to need to fill in. It's a couple of hundreds of them, but here you can, for instance, see what the safe harbors look like. So they have the boxes, and then they have some explanatory notes about what data needs to go into which box and which box refers to which article in the Globe rules, etc., etc. The only problem is that the boxes and the notes are in separate parts of the guidance. So the boxes are in the first half and the guidance in the second half. So you need to page back and forth quite a bit to figure out what's going on. What we've done is we've taken all these boxes and the information and we've combined them together in a PowerPoint so you can see the guidance directly underneath the boxes, and also copied things from other sources that the OECD published here and there, such as, for instance, on what the definition of financial accounts are, what an acceptable corporate tax calculation is, etc., etc. So when you've done this, just looking at the high level of how the boxes fit into each other, you first get a set of boxes which deal with the group information. So this tells you how your corporate structure looks like, who owns what, etc., etc. Then you come to the safe harbor exclusions, and the nice thing is if you fall under any of the safe harbors, then basically you only need to fill in these two sections of the Globe Information Return. It's not quite true because we need some minor parts from the rest of the return, but this is going to be your basic, and that's why it's so important to start with the jurisdictional safe harbors. And if you don't fall in the jurisdictional safe harbors, then you need to go and do your full Globe computation, which is going to consist of making your effective tax rate computation and then your top-up computations. So the full Globe tree looks something like this. So you can see there's quite a number of boxes to complete. I've done it down to 4 levels, but there are, again, like I said, I think about 250 of these boxes that need to be completed, depending on how you count. But you can see here is the corporate structure. Now, this is probably something that you largely will fill in once and not again unless you have new subsidiaries or you move subsidiaries or you sell subsidiaries, things like that. But that will be relatively static from year to year. Not important for the impact assessment, but just as an introduction. Then for your impact assessment, you're going to want to start with your safe harbors. And you can see that's in section 2, as we already have seen. But for some of your safe harbors, you're going to need to calculate your substance-based income exclusion, which is part of the Globe computations already. And you're also going to need to do the same for your taxation, because you cannot just copy your tax from your country by country report. If you do fail all the safe harbors, then you're going to have to do your constituent entity calculations. And I'm saying constituent entity because most groups start by looking on an entity basis at all their numbers, and then they add them together for that jurisdiction, right? So you're not going to start with your jurisdictional basis because that's not the way your ERP system is built up. You're going to start with your income and loss. So you're going to start with your commercial P&L, and you're going to add back a number of things, and you're going to take next step, you're going to calculate your adjusted covered taxes. And in the first step, you will just take your taxes from your commercial accounts again, and then make a number of adjustments. And a large complexity comes in when you then need to start working with the Globe deferred taxes, because it does kick up quite a bit of calculations. But this is basically what your impact assessment is going to look like. So if we start with the safe harbor elections, we've just seen that we'll go from section 2 to jurisdictional exceptions. So that's what you look at in the return, and you go to your transitional safe harbors and your permanent safe harbors. And then for your transitional safe harbors, here are the different safe harbors that you need to look at. If we look at them a little closer, and we start with the transitional one for your simplified effective tax rate. So all the transitional safe harbors, you can basically take the data from your country by country report, except you cannot take the taxes from the country by country report. They say you need to start with the taxes in your commercial accounts. You need to add back any deferred taxes which are not in the commercial accounts already, and you need to take out any uncertain tax positions both with regard to current tax and the deferred tax, and that will give you something called the simplified covered taxes, right? And if you divide the simplified covered taxes by the EBT in the CbCR, you will get your effective transitional safe harbor tax rate. And if that is, at least for 2024, 15% or higher, you don't need to do further calculations for that entity. If you don't do that, you can always try and do your de minimis test. And the de minimis test simply says that you look at your CbCR numbers, and if your turnover for that country is less than 10 million euros and your EBT is less than 10 million euros, then you are okay and you don't need to do further calculations, because that country is too small to really make a difference and is most likely not used for large scale base erosion, right? If you fail that, you can go down to G, which is your routine profits test, or your substance-based income exclusion. And what this basically says is, it says, if you take 10% of your wage costs, or 9.8 actually for 2024, I believe, and you take 8%, which was 2023, but then they deferred the implementation of Pillar 2, so now it's 7.8% of your tangible assets, and you add those two together, and those two together are larger than your CbCR EBT, then they will assume that this is a low tax or a low profit entity. It has a lot of substance, otherwise you can't get a high number with your wage costs and your tangible assets, and therefore you do not need to worry about this entity any further. Right now you can see you've got it in your simplified transitional safe harbors. You also have it in your permanent safe harbors, and the difference between transitional and permanent safe harbors is the transitional safe harbors, as the name implies, stop, I believe, at the end of 2028. The permanent safe harbors are supposed to continue going on. Now, when you've done these three tests, and you still have entities left, you can try your UTPR safe harbor, we'll talk about that later, but you can also go to your permanent safe harbors, right? You may actually find that, strangely, you qualify for the permanent safe harbor even when you don't qualify for the transitional safe harbor, especially for the ETR test, because you calculate that based on the globe numbers, and that might just end up being slightly different than your CbCR numbers. And you have this thing, the qualified domestic minimum top-up tax. Now, I'm not going to spend a lot of time on this video on the QDMTT for two reasons. One is a lot of countries have not implemented it yet. And the second reason is, if you're trying to make an impact assessment, what you want to know is whether you're going to pay more tax and where you're going to pay it. And quite frankly, whether you pay a Pillar 2 top-up tax or whether you pay a QDMTT doesn't matter that much. Either way, you're going to pay more tax, right? So we kind of leave the QDMTT aside for calculations from here. As far as the UTPR safe harbor is concerned, the way I understand the globe return, this is only for the ultimate parent jurisdiction and only when it has a nominal corporate tax rate of more than 20%. So we will leave that aside for now. When you are doing these calculations, if you are using our template, then you will have in the front already your CbCR summary, which you can see here. I've just hidden the numbers and added on to the CbCR, which stops at the tangible assets. We pick the numbers for you and you can fill them in, so we can do the tests right next to the CbCR to see whether you are passing any of the transitional safe harbor tests. And if you do, then you can stop with those. And then, for instance, in this case, in the top 3 countries, we have no transitional safe harbor. So now we're going to do some of the globe calculations to see if we fall under any of the permanent safe harbors, and then we can take it from there. And then we also have included in this, which you need, as I indicated here above, special calculations for your substance-based income exclusion or your routine profits test, where you would need to fill in your payroll cost because that's not part of the CbCR. You can take for the transitional routine profits test safe harbor, you can take the tangible assets in your CbCR report, and then you can go and calculate what your SBIE is. And one thing to remember in this is that if you have an EBT of 0, you by definition qualify for the routine profits test, right? Because you only need $1 in salary or in tangible assets to already have a SBIE, which is bigger than your EBT. Let us go through a very quick top-up tax calculation. It's important to understand this to see where it belongs in the globe return, and if you use a tool in the tool, but also to know how to make cross checks for your outcomes to make a reality check, right? So you're going to start by your globe income, which is going to be your financial accounts net income or loss, and in our case we say that is 1,000. You're going to add back to that always the taxes in your net income, because you want to calculate your globe earnings before tax effectively. You're going to take out any excluded dividends because the dividends are exempt and you don't need to include them in calculating your effective tax rate. You're going to add back any fines that you've deducted in your financial accounts, which is something you already do in your tax accounts very often already. And then you end up in this case with a global income of 1,200, let's say. You then are going to calculate your adjusted covered taxes. And again, you start with the taxes in your financial accounts and you allocate them according to Article 4.3. So you deal with your CFC income and your dividend withholding tax and all those kind of things. You're going to deduct any dividend withholding tax on excluded dividends, because since dividends are not taxed, it makes no sense to include any dividend tax on those dividends because that will not give you the right effective tax rate. You will allocate the dividend withholding tax to the entities who distribute their profits because it's part of the taxes on their profits, but that's in a different step. You will take out your uncertain tax positions, as we already have talked about, and then you calculate your adjusted covered taxes, which in this particular case we say is 120. You calculate your effective tax rate, which now comes to 10%, being 120 divided by 1,200. So our top-up tax rate will be 5%, being 15% minus 10%. And then we're going to now calculate, once we have our top-up tax rate, then we calculate our substance-based income exclusion. So let's say we've got payroll of 4,000 and we work with a 2023 percentage, so we can take 10% of that, which is 400. We've got tangible assets of 1,250 and we take 8% of that, so that's another 100. So our substance-based income exclusion comes to 500, which we now can deduct from our globe income. So that gives us an excess profit of 700, being 1,200 minus 500 equals 700. Now you multiply that 700 with your top-up tax rate to give you the top-up tax that's going to be paid somewhere, being 35. Now, where do these different things fit into the globe return? Obviously, the globe income is under 3.2, the effective tax rate. You start by computing your globe income. And this is what it looks like in the globe return that we looked at the beginning of this video. And this is what you fill into the globe return tool. As you can see, the numbering matching what is in the globe return itself. Next, we want to look at the adjusted covered taxes. And again, you go to the effective tax rate, T3212, computation of the covered taxes. And I do this on a per entity basis. These are, again, the boxes from your globe return. You can see you start with all kinds of adjustments. And if you look at number 3, so you start in 2 with your financial accounts, then you go 3 and you make a number of adjustments, and you can see it goes from A to R. So there's quite a number of potential adjustments, but you'll only make a few of them because they also cover all kinds of things like shipping, transparent entities, etc. And then you end up with your adjusted covered taxes. And these you fill in your tool as well. And then next we're going to calculate the effective tax rate, which again looks like this in the globe return boxes. So these are the boxes that you add together, and there's all the commentaries under those boxes that you need to consider. And here are the numbers from the tool. And then finally, you calculate your substance-based income exclusion and your top-up tax, which looks like this in the globe return. You can see the top-up tax percentage is 15% minus your effective tax rate that you've calculated, 10% that we have done in our case. You deduct the substance-based income exclusion, and then you get your excess profits, and that you multiply with your top-up tax effectively, and then you can do your QDMTT deductible, etc., etc. Again, QDMTT not that relevant for an impact assessment by itself. And these are just the boxes that you fill in the tool that we've created. And then obviously there are many rows more that need to be done. And just to connect the dots here, you can see we had a globe income of 24. We have a substance-based income exclusion of 5. So we end up with an excess profit of 19, and then we will calculate the top-up tax over that. The next step will be to allocate the top-up tax, but that is not part of the impact assessment. We've just tried to figure out for which countries we will be paying top-up taxes. In our next video, we will go through the basics of the deferred tax calculations and how they mash up with the globe information return. Bye for now.